Hello friends, how you all doing? My greetings to you all. Welcome to today's lecture. So grab your notebook and your pen and let's get started. So this class is going to be on what we trade. So what we trade in Forex. So currencies, that is what we trade. So currencies is the commodity we trade. Think of it as the business of buying and selling money between countries. If you remember the previous lesson about why we actually participate, why there is a foreign exchange in the first place. There are many reasons to exchange currencies to a country that you're going to purchase goods in another currency, sometimes for investment purposes, sometimes for speculation purposes. So currencies is what we trade, and that is think of it as the buying and selling of money between countries. So examples of currencies that can be traded, all currencies can be traded or exchanged, actually, but not all currencies are advised to be traded or exchanged in the online trading industry. That's forex trading online. Not all currencies are encouraged to be traded. So we have the United States dollar, we have the Great British pound, we have the euro, we have the Australian dollar, the New Zealand dollar, the Japanese yen. Now we'll have the Swiss franc, but the abbreviation for the Swiss franc is CHF. I'll come back and explain that. So we have the Nigerian naira, we have the Chinese yuan, and we have the South African rand, and many others. We have the Saudi Arabian riyal, many others. We have the Omani Dubai's dirham. We have many currencies, which certainly know. So I highlighted this in yellow just to give you an idea of how the abbreviations come about. So the United States dollar, for instance, is just taking the first letter of each word in the name of the currency, in the full name of currency. So you have USD being the first letters of United States dollar. So again, British pounds, Great British pounds, Australian dollar. So AUD takes AU, then D. New Zealand takes NZD. So Japanese yen JP, and then Y. So the Confederatio Helvetica franc is Swiss Confederation franc. So that's why it is CHF, and it is not it's not named like the other. So it's the French name that the CHF is derived from. So we have the Nigerian naira NGN, taking NG from Nigerian N from. So also then we have the Zuid Afrikaans rand. So the Zuid Afrikaans rand, that is Dutch. Yes, it's the Dutch name for rand. So that's why it's Zuid Afrikaans. So that's why South African rand is popularly known as ZAR. Ordinarily, it should be SAR, but yeah. Zuid African also means South African. So Zuid means South. So yeah. So we have currency pairs. So when you bring one or two things together, when you bring two currencies together, you have a pair of shoes, a pair of bracelets, a pair of watches. So anything that is two things coming together is a pair. So we also have currency pairs because when we trade, in the moment you do a buying, there's also simultaneously a selling. So you cannot buy without selling, you cannot sell without buying, you cannot give without taking, you cannot take without giving. So in the buying of a currency, it means you are selling a particular currency. There is a currency you are exchanging together currency. So in this regard, there is always two currencies being transacted at the same time. It's either you're buying one or selling this and buying the other. So because of that, there is something called a currency pair. So a currency pair is just a standardized way of understanding the two currencies that is played in this instance in this exchange. So we have currency pairs like the Euro USD, that's the euro and the dollar, the American dollar. We have the Japanese yen and the British pounds. We have the USD and the naira. So these are pairs. So each pair shows how much one currency is worth compared to the other. So that's the idea of a currency pair. The combination of two currencies is called a currency pair. So how currency pairs work? So a currency pair is written in two parts. The first currency is called the base currency. So the base currency is the one whose price is being quoted in. So I'll explain that clearly. So the second currency is called the quotes currency. So if Euro USD is 1.100, it means 1 euro is $1.1. So the base currency is the one that is in front. That's the euro in this case. So the base currency is the one that the base currency is always in one technically. So the base currency is always in one. So the base currency is the one is technically is one of this currency is equals to that is equal to this amount of the second currency. So the base currency is always one because it's the base. So one of this currency is equals to that. So you can technically write it as one. So in the Euro USD pair now, in your mind, you can technically see the Euro USD pair as being written as 1 euro equals to so USD. So if you have Euro USD, Euro slash USD, it can technically also be written as 1 euro equals to 1.100 USD. So that's what it is. So the base currency is the main currency. The quote currency is the currency whose price is going to be quoted in, but whose price the base currency is being quoted in. So if the price goes up, the euro is getting stronger, and if the price goes down, it's getting weaker, and the US is getting stronger. So why this matters? All forex trades involve buying one currency and selling the other at the same time. There's always a simultaneous purchase and a selling at the same time. You are not just guessing if your currency will go up or go down. You are deciding which one will be stronger in the pair. That's the idea. So technically, if you want to buy Euro USD, you're technically saying, I think the euro is going to get pretty strong, like very strong, stronger than the dollar. Like the or it could be converse, it could be inverse, it could be say, I think the dollar will be very weak. So the euro may even remain the same, but the dollar gets very weak, and then that can still show the prices of Euro USD up. So if you trade USD NGN, you are buying USD and selling NGN if you think the dollar will rise. So in any instance, if you buy one, you are selling the other. If you sell one, you are buying the other. So for instance, if you sell USD NGN, you are selling the dollar and buying the naira. So that's what it is. So if you buy a pair, that means you are betting that the currency in front will go higher and the currency behind is dropping. If you sell a pair, that means you are predicting that the currency in front, which is the base currency, is going to lose some value, and then the quote currency, which is the currency behind, is going to increase in value. So uh, you are selling you're selling USD and buying engine if you think the naira will get stronger. Not all pairs are created the same. They are grouped based on how often they are traded and the strength of the economies behind them. So we have three major categories of currency pairs. We have the major pairs, we have the minor pairs, and we have the exotics. So major pairs, these are the most traded currency pairs in the world, and they always include the dollar. Major pairs are currencies of major economies paired with the dollar. So major pairs are the pairs of the big economies in the world and the dollar. So we have Euro USD, which is the Eurozone currency, Euro USD, Pound USD, Japanese yen, the Swiss franc, AUD USD, NZD USD, and USD CAD. Those are the seven major pairs. So it is not just all pairs that are paired with the dollar, because you can have NOK USD, which is the Norwegian krone paired with the dollar, and that is not a major pair. So it is not just currencies that pair with the dollar, it is currencies of the major economies paired with the dollar. That's what a major pair is. They are popular because they have high liquidity, tight spreads, and predictable movements. When starting out, these are the best pairs to trade. Minor or cross pairs. So minor pairs or cross pairs. So these are currency pairs that don't include the dollar. They are still from strong economies, but they have slightly wider spreads. So example is euro and pounds, Japanese yen and Great British pounds, the euro and the CHF. So now think about it like this. I just said the major pairs are pairs of major countries paired with the dollar. So when you now cross or when you pair these major currencies with themselves, you're not pairing AUD with the euro. So euro AUD, that is a cross or a minor pair. It's no longer major because the US dollar is what makes them a major. So this is what a cross is. It's a cross is pairing all the other. A cross is pairing the seven big economies with the dollar with themselves. That's what a cross is. So crosses are useful for diversification and reducing risks that can come with trading solely the dollar. So exotic pairs, these pairs include one major currency and one currency from a developing or smaller economy. So examples are the USD NGN, Euro and the Turkish lira, the dollar and the South African rand. So when you have a major currency now paired with a developing country or a smaller economy. I'm emphasizing smaller economy now because the Swedish currency, the Norwegian krone, these are these are these are not developing countries, but they are small economies in regard to the big players in the world. So when you pair the USD or you pair pound, so euro krone, euro and the Swedish krone or the Norwegian krone, it's that is an exotic pair. So they can be more volatile, have lower liquidity, and higher transaction costs. It is best to avoid this as a beginner, and even more advanced traders rarely trade them. And this is because they have very little liquidity. How many people are exchanging their major currency to naira or exchanging their major currency to Turkish lira or South African rand or the Kenya shillings? Very few people will be doing that. Very, very few. So there's very little liquidity coming into these economies or these currencies. So that's why they can be quite volatile and have very low liquidity. So in this regard, when you want to exchange these currencies, you can expect that the broker or the money exchangers will take a high fee because not many people are doing it. So they cannot make money from inflow of transactions. There's not many transactions. So the few transactions that they see has to cover for the cost of doing the business. So that's why they have very little liquidity. Okay, so that brings us to the end of what we trade. And this is just a brief overview of what Forex is, what pairs and currencies are all about. So again, there are three major kinds of pairs, currency pairs. So we have the exotic pairs, we have the minor or crosses, and we have the major. The major is when you pair the seven big economies of the world with the dollar, which are the Eurozone, pound, Japanese yen, CHF, Australian dollar, New Zealand dollar, and USD card. If you observe, the way they are written is quite different. So you have Euro USD, Pound USD, USD JPY, USD CHF, AUD USD, NZ USD, and USD CAD. So ideally, the idea is that the bigger the currency with the bigger value is usually in front. But in the case of pairs like USD JPY, sometimes it can fall below one. So basically, the idea is that the currency with the better value is usually in front. So your Euro USD is 1 point something, which means that Euro has more value than the USD. Pound USD is 1 point something, which means that, so that's the idea behind it. But it can change as well. But this one is very, very minute. You will get used to it the moment you start involving yourself in the charts and currency pairs. It's very easy to grasp. So yeah, there are minors. Minors is when you pair the major economies with themselves, the euro and the pound and the yen and CHF, CAD and CHF, all like that is what you get when you pair them together. That's a cross. And then the exotic is currency from a developing economy or a small economy paired with one from a major economy. That's what currency pairs. And we have the base and the quote currency. The base currency is always one in value. So the base currency is one of this currency is equals to that of the quote currency, which is the second currency. So the quote currency is the currency is it's in the quote. It's called quote currency because it's in the price of that currency that we will quote the main currency or the base currency, which is the first one. So again, these are very easy to grasp things, and yeah, currency pairs are all about. Again, there are so many of them. Check all the currencies of the world. Check as many as you can, and just see how their names are being abbreviated, and you see some similarities there. And yeah, so this brings us to the end of currency pairs. It's not a very grandiose topic. Yeah, I hope you found this insightful. If you have any questions, shoot them to me. And until the next lecture, I wish you all peace and good luck.